In this video, we are going to talk about off-balance sheet risk. Just what it sounds like, items that are risky, but not necessarily seen in the financial statements, the balance sheet specifically. Off-balance sheet risks, you got contingent assets and liabilities. Keyword here is contingent. Assets and liabilities off the balance sheet that potentially can produce positive or negative future cash flows for a financial institution. In other words, things that you have or things that you have as an asset, or things that you owe as a liability that are not on the balance sheet, but have implications on the cash flows of the company. And if it has a cash flow implication, it has a value implication. Derivative securities held off balance sheet. These are probably the most common items: for contracts, future contracts, options, and swaps. Now, we will elaborate a little bit on this here, but do understand that these are very common tools used to hedge a lot. So you may have these. Not only some financial institutions may sell these, like a brokerage company, for like a broker for their clients, but they may also use them as hedging tools, and therefore, but they're not on the balance sheet. But depending on which way direct the things in the future happen, cash flows may be affected. So, off-balance sheet activities and financial institution solvency. So an item or activity is an off-balance sheet asset or liability if, when the contingent event occurs, the item or activity moves on to the asset or liability side of the balance sheet. Rough, oversimplified, imperfect example: you have a future contract to buy an item at a certain price. At that point, when that gets executed, you actually purchased it for that price, a cash flow was triggered, and now you own that asset. Now it's in the balance sheet, and your cash was impacted as well. And the opposite is true with a liability. If you're going to sell something, for example, or you promise to deliver something in the future, a payable, which could happen through a future contract as well. That'll be the example of oversimplified example for the liability side. Valuation of balance sheet items, delta of an option. There's this thing called the Greeks. That belongs in a different class, a different course, but they call them the Greeks because options have these different calculations that are done to understand the value of the option. And they call it the Greeks because there's a series of Greek letters. Delta, probably the most popular of them of all. If you're interested, feel free to go to the internet and look up options, the Greeks, and I'll talk about them. Notional value of an off-balance sheet item. So notional, just what it sounds like, the perceived value in a way, if you want to use a different word. Okay, so delta equivalent or contingent asset value equals delta times face value of option. As I mentioned, we're not going to get into what delta comes from, gets calculated. Just understand delta is a value, a number that is used to get information from options as value, for example. Returns and risk of balance sheet activities. Additional fee income to offset declining margins or spreads on traditional lending business. So here, what they're talking about, if you're the financial institution and you're selling this product, like a future contract, a forward contract, an option or swap, or any other form of off-balance sheet item, then you may charge fees for this service. So you get it's a point of income to provide these services for your clients. Avoidance of regulatory costs or taxes, things that are not levied on the off-balance sheet activities. Reserve requirements. It doesn't impact the cash reserve you must have, because the cash reserve is going to be dictated by whatever's on the balance sheet. Deposit insurance premiums. So any insurance so the deposits in the financial institution that are insured, a premium is charged. It would not affect that. Capital adequacy requirements. This is about risk management. For example, after the financial crisis of 2008, the capital adequacy requirements became tougher. This wouldn't have an impact on that because it's off the balance sheet. And to measure if your capital is adequate, it can only be done. It's not that it can only be done. It's done with whatever's on the balance sheet. Schedule L activities. So this was something what we have spoken about up to this point. It's not new 2008 in that sense, but here are some examples of ways where regulation was trying to not control, but manage these risks when there are off-balance sheets items involved. So Federal Reserve introduced a tracking scheme in 1983. As part of the quality call reports, banks and savings institutions, financial institutions with deposits in it, began submitting Schedule L, on which they listed the notional size and variety of their off-balance sheet activities. So they had to submit like an inventory of the things they had that could impact cash flows, but that would not on the balance sheet. The Volcker Rule ensures only the investment banking arm of the business can conduct proprietary trading. Again, another simplified example, maybe imperfect, but you get an idea. And I'm going to go outside of financial institutions for a moment so it makes more sense. Let's say you're Walmart or IBM. So you're not in the finance sector. So that's not your industry. That's not your main business. Walmart sells stuff retail. IBM sells computers and other stuff, but let's say computers for now, or computer equipment, software, etc. The point is that they are allowed to have off-balance sheet items like future contracts and options and swaps as a hedging tool in order to lower the risk of their company. However, they're not allowed for those to be an income point. In other words, they cannot just start playing trading stuff and speculating with that, or doing a lot of them that are not necessarily for the mission and for the company. And that's what this Volcker Rule, part of what it does. So within a financial institution, they have to separate, to an extent, the operations to make sure that only the investment banking arm, not your commercial banking or your, the personal banking, they cannot be doing a high risk speculation and trading with those, because then they're putting the cash at risk of the depositors. Unnecessary risk. It was not always like that, but that is the intent. Major types of off-balance sheet activities for U.S. banks: loan commitments, standby letters of credit, and commercial letters of credit. Okay, so a letter of credit, we'll expand on that in a moment, but just understand why it's listed here. Think of it as an account payable, but it's just not on the balance sheet because it's not effective yet. So a bank can help to be as a middle institution, a middle organization, the middle person between two companies trying to do business. So company A wants to buy something from company B, but they don't want to pay until there's some kind of evidence that the product is being shipped or was shipped or they received it. Company B says, well, I'm not going to send you anything until I get my money because we're guaranteed to have to get the money. So the bank, the financial institution comes in between them. And let's say company A is buying from B. The financial institution checks with company A, checks their assets, their credit worthiness, etc. And they can issue a letter of credit to company B saying, like, they're good. Go ahead and get the shipment going and we'll pay you as agreed. The letter of credit kind of guarantees that. Futures, forwards contracts, future forward contracts, swaps, and options, as we mentioned before. These are used to lower risk on future price changes or hedging positions many different ways. When issue securities, roughly defining that is, I'm going to sell you shares now, but you don't get them until they get issued. Let's say like a new issue is coming out. So you can sell them now like a pre-sale. You'll get them when they are issued. Loans sold. Just like it sounds like, companies may originate a loan and then sell it to another company. Loan commitments, loan commitment agreement. Contractual commitment to make a loan up to a stated amount at a given interest rate in the future. Very similar to a future contract in practice. Of course, the laws and the way it's written, a lot of different items are different. But the point is that a borrower may lock in a specific interest rate, amounts, etc., and to borrow money in the future. Not always obligated to do so. So at that point, it's more like an option. But once the bank says, here's the contract, so whenever you want to borrow, if you want to borrow, there's the interest rate and there's the amount, etc. These are the terms. So at that point is not in the balance sheet. Now, there's a risk for the lender that if interest rates go up, they have a contract for a lower interest rate for that borrower in the future. And this may affect the value of the company, the cash flows, because that means they're going to receive less cash flows than what the economy is or the market is currently not dictating, but available in the market out there. So you lose value. However, why do banks do it? Well, because as you see here, just like an option or contract, there's a fee. So they can still make money. Contingent risk effects, interest rate risk. As I mentioned in my example, if you are in one of those loan commitments with a contract with a rate guaranteed, if the interest rates go up in the future, you're losing that opportunity to collect that money. There is basis risk as well. Is the variable spread between a lending rate and a borrowing rate, or between any two interest rates or prices. Takedown risk. Uncertainty involved with the timing of the takedown of a loan on a loan commitment. Bottom line, you enter in a loan commitment, you collect the fees, okay, great. But anything that changes moving forward, it is not on the balance sheet yet because it hasn't been executed yet, but it could go in your favor or against you. Contingent risk effects, credit risk. Oh, there's a good one. So you made a loan commitment today with company XYZ. They had an excellent credit rating at the time, but this loan commitment was open for, let's say 2-3 years on the road. I'm just making up that timeline. It doesn't have to be 2-3 years. And probably the fee will be pretty high for that length. But let's say 6 months or a year, it doesn't matter how far in the future. The point is that all of a sudden, the companies start getting into trouble something really happened on the demand side or regulation hit them, whatever it is, that their credit risk went up. They are riskier now than we were when you did the loan commitment, but you already have the contract in place. So you can now then change the terms of the contract, the commitment, based on the new information. Aggregate funding risk. During a credit crunch, bank may find it difficult to meet all commitments. Let's say a bank has a bunch of loan commitments out there, but the cash has not gone out because those borrowers have not borrowed money yet. But then let's say some a recession or anything in the economy turns where, let's say, supply of money is low, whatever the case may be. But in a credit crunch means very little money available to lend out. Maybe the Fed decided to increase the required reserve. The point is that if there's less cash to lend out, and all of a sudden these borrowers all come at the same time asking for money to borrow according to their commitments, the contract that you made with them, they may be an issue. You may not be able to meet all your commitments. And that's going to become an issue for the value of your company. And this may be compounded by externality effect on rising interbank borrowing rates. Similar to what I was explaining earlier, that if interest rates change, it could go against you because you already put a specific rate on that commitment. So within the letter of credits that we spoke about earlier, there's commercial and standby letters. So the commercial letter of credit is contingent guarantees sold by financial institutions to underwriter, the trader for the trade of commercial or performance of the buyer of the guarantee. All those words to say what I mentioned, or the example I mentioned earlier, where company B is selling to company A, so they initiate the transaction, or could be a service. So that's what they call performance, the commercial performance. And then the letter of credit serves as a guarantee that they will get paid. And that's why it says they're particularly important for foreign purchases, though are used frequently for domestic trade. Yes, the same way when somebody, or very similar to when somebody buys a house, there's an escrow account where money has to be deposited. So the money is guaranteed that will be there for when the transaction completes. And that's a domestic transaction. Same letters of credit can be done between companies in the same country. But it's used also international a lot. A standby letter of credit guarantees issues to cover contingencies that are potentially more severe and less predictable than those covered under a commercial letter of credit. This is what happens. A commercial letter of credit will have the conditions that need to be met in order for the seller to receive payment. What happens a lot is that if the commercial letter of credit is very detailed and strict with a lot of conditions, then the seller's not going to agree to sell. They're going to say like, no, because then it's too easy to make a claim and not receive payment. Like, not that the buyer will cheat, but it becomes too risky for the seller and maybe not even worth it. So what happens is there has to be a little bit of flexibility and some looseness to the commercial letter of credit. Now comes in the standby letter of credit to cover for any nuances that happen that were not covered on the commercial letter of credit. That's one way to look at it. Here's what we said earlier. In this case, international, U.S. buying from Germany. They want to order $10 million machine or worth of machinery. German exporter says, like, pay me first, for example. US says, no, you send it first and then I'll pay you. Makes sense, right? That both sides want, one side wants the money first, the other side wants the product first. So this is the financial institution. So the importer, the buyer, works with them. They verify whatever they need to verify. They issue a letter of credit saying, Germany, go ahead, get it ready and send it. Your money, their money is good. We got it. And they do that through a letter of credit. At that point, the German exporter will first make all claims of payment here if there's any issues or problems. And if for some reason that fails, then it becomes more of an international situation where then, you can go to the importer, try to deal with it, etc. It depends on the situation. But they send it to them directly, but they collect money and solve any money issues here. Derivative contracts. As I mentioned before, used by financial institutions for hedging, other purposes as well, but hedging is the big one. Not that trading, and what by big one I mean as in the key one we're talking about here. Because if you were to look online, derivative, the markets like the trading and the speculation, that's huge. But here is one of the key ones that we talk about that within this context. Financial institutions can also be dealers of derivatives, as they sell the product, the tools, the those financial tools. Four big dealer banks are, but not the only ones: JP Morgan, Citigroup, Goldman Sachs, Bank of America. They have about 88.7% of the pie. Futures, forwards, swaps, and options. Those are your most common derivatives. Now, forward and swaps contracts involve substantial counterparty risk. Options and futures have their own set of risks. However, forwards and swaps are riskier in that sense. When issued security, as we mentioned earlier, an example, commitments taken a week prior to announcement of T-bill auction results. In other words, you sell something now, it's like a pre-purchase. Now, the risk is that, let's say you agree to buy a stock now when issued, and then a week later, 2 weeks later, a month later, whatever the time is, when they come out, the price was lower than what you agreed to pay on the when issues contract. But the opposite can also be true. And that's where the risk is there. And this is what they mean by overcommit or underprice. Loans sold. Financial institutions may take the role of loan broker. So let's say I originate a loan, but I don't service it. Then I just sell it to a bank, and then they take over. This is very common. You hear in the news all the time. Now let's talk about the point here of recourse. There's a risk situation. Where does a risk fall on? So let's read. Is the ability to put an asset or loan back to the seller if the credit quality of that asset deteriorates. So I originate the loan. I sell it to bank XYZ. Now, it doesn't have to be, but if something goes wrong with the lender, like their credit quality, or something changes, is different from the loan when I originated it with the borrower, they may then send it back to me in a way, saying, yeah, deal with this. That's what the recourse is, sending back to the seller. That's when there is recourse. No recourse means that once I sell it, they absorb all responsibility for whatever happens in the future. Settlement risk is intraday credit risk associated with CHIPS wire transfer activities. Okay, so let's start with this FedWire, domestic wire transfer network owned by the Federal Reserve. So banks, financial institutions transfer money through here, for example. CHIPS, international and private network, owned by approximately 50 member banks. So it's an electronic system to wire money, and about 50 banks got together, and they all have a piece in it. For a small portion of funds, settlement may take place only at the end of the day, resulting in intraday settlement risk. What happens is or what they're trying to say here is that, let's say in the morning, there's some kind of transaction, but it's just being processed, and then it doesn't get settled into the end of the day, or even in the next day for that matter. But because it's intraday, we're talking about here, it gets settled at the end of the day. The thing is that as things move fast, the market conditions in the morning may be different by the end of the day. And when it's settled end of the day, it will settle to those market conditions. And you have intraday settlement risk. Or the conditions of the borrower. Affiliate risk. Affiliate risk is imposed on one holding company affiliate due to the potential failure of the other holding company affiliates. Okay, so you may have companies that, while they're different companies, they're affiliated with each other. However, when you're lending to that company, you're lending to that company alone, not the affiliates. But because of that relationship between all those companies, the other ones, affiliates, if something bad happens to those other ones, it may and most likely will have a negative impact on the one you're doing business with. So this is affiliate risk. The company stand as a standalone, when you evaluate it, it's fine. But then when you look a little deeper and it's so tied up with all these other bunch of other companies that may be high risk, that might be an issue you have to consider. Risk reduction. In many cases, off-balance sheet activities are for hedging, as we mentioned so far. Off-balance sheet activities are a source of non-interest income. As we mentioned, the fees, especially for the largest and most credit-worthy financial institutions. So far, these are things that reduce risk. The hedging part, source of income, changes in regulations controlling over-the-counter derivatives in 2009. That year is not a coincidence. That is because of what happened in 2008, the financial crisis, especially the credit default swaps. The CDS here, he's one of the huge perpetrators of the whole issue. While it was a chain reaction and a lot of items in play, credit default swaps received the most attention because of the how they were such a big player in this financial crisis that happened. Let's talk about regulation. It increased in 2009. Again, not a coincidence, right after the financial crisis. But they had 4 broad objectives. A lot of regulation came out, but these were the 4 key objectives. Prevent derivative markets from posing risk to the financial system. Earlier, we talked about how the trading of derivatives could only be done within the investment bank arm of a financial institution, not the other arms of it, like a depository. Promote efficiency and transparency in derivative markets. More information. That's just saying, let's have more information about derivatives markets available to the public. That will be more transparent, and that leads to more efficiency. Prevent market abuses, market manipulation, fraud, etc. I always like to mention the movie The Big Short because they do bring up market manipulation and fraud and just bad behavior in general, whether it was illegal specifically. And that's the point: prevent market abuses. Ensure over-the-counter derivatives are not inappropriately marketed to unsophisticated buyers. Similar to a hedge fund, you have to be a qualified buyer to have money invested in a hedge fund. Venture capitalists, crowdfunding. There's all kinds of regulation that is to protect people that, when they say sophisticated, people just don't know much about finance or about how these things work, but they want to speculate. They want to play in it. So just want to make sure that those people aren't being targeted. They don't want predatory behavior. Another word used of finance instead of unsophisticated is naive investors. But the point is, people that are not very familiar with what they do in, they don't want them to be predated by the sellers of these items. That's it for this video. We'll see you on the next one.